It's extremely easy to invest in the stock market for great returns if your time frame is long enough. You buy the index and keep buying it in a dollar-cost average way. The bet is that as long as an extinction event doesn't reverse progress, then the index will grow with the world economy and its population. There will be lumps and bumps along the way, but they will wash out, leaving you a compounding 7% return. If you invested $500 a month for 30 years, that would leave you with $600,000 for an investment of $180,000. Without investing another penny, that would bring you to $1.2 million in a further 10 years. Nobody cares, however. No one wants to wait to get rich. In general, most want the sort of incredible returns no one gets and end up taking on too much risk, often turning investing into a gambling habit. So most of us are left looking at ever shorter and shorter time windows to try to extract wealth from the stock market. At the extreme, the day trader nips in and out of stocks in minutes to such privations that there are controls over playing the market like a fruit machine. Looking at the stock market over the long term is a good way to estimate the future market outcome and better time the market, not to the hour, day or even month, but in general, to help scrape a little more return by at least being able to invest a little, better than blindly. Hardly anyone cares to look at the long term, so those that do get an edge. Where people don't, won't or can't look is where the signals lie. So let's take a look at the S&P 500 over the long-term horizon. The S&P 500 has been making classic head and shoulders bear patterns. It's enough to make anyone nervous, run for cover, yet the magical levitation of U.S. markets over the years remains in place, and there is a striking trend to prove comfort for longs. Why actually has the market been so strong when all around is quivering from the aftershocks of the pandemic? We should know why. The Federal Reserve has been zigging and zagging money supply to try and keep the U.S. economy on the rails, and to do that it has to keep assets like stocks from imploding, and it's done a pretty good job of that. As a side note, this could be considered as facilitating the runaway spending of the U.S. government, but as the folly of others should be a blank check for smart investors. Why complain? Here is the chart of the S&P 500. So the question is, are the U.S. indexes heading to the moon or the turf? Everything to do with U.S. markets is to do with the Federal Reserve's money supply management. Stocks go up because money supply goes up, and by the way, it is the same for crypto. When the Fed is tightening, down goes the market, and it is hard days for investors with only GDP growth and inflation to prop up prices. The Fed will stop tightening at some point, but when? That I think will be around the time the banking system is out of excess money, and that can be tracked by balances in the Fed's reverse repo system.